What's up, guys? I was looking at some of the reasons why people are afraid of investing in the stock market, and I came up with these 5 stock market myths that are really kind of the main reasons why people don't start investing in the stock market or they don't stay in the stock market. And I do hope that I can address these myths in this video, so make sure you stay till the end so you can see all 5 and really understand why people don't stay in the stock market. All right, let's get to it. Myth number 1. Investing in the stock market is the same as gambling. No, they are totally different. I need to get this one straight with you guys. There is a difference between doing investment research, looking at the profitability of a business and its long-term growth potential, rather than playing chips and throwing dice and seeing if you are lucky or not. There's a very, very big difference, right, guys? If you see that Google, right? You believe that Google is going to keep on growing? Yes. And why? Because it is a profitable business. It is growing. It is strong, right? But do you believe that the next dice that you throw will get a 6? There's only a 1 in 6 possibility, right? So, myth number 2. You need to invest a lot to make a lot. This is also wrong, but it can also be right in a sense. And what I mean by this is that, say you have $1 billion, right? How easy is it to make 1 million when you have 1 billion, right? That's 10% of 1%, right? That is super easy, 1/1000th. But compounding, that is what I mean by this. Albert Einstein, he has a quote. He says, "Compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it." What this means is if you don't learn it early enough, you're going to miss the opportunity. You are not going to get the benefits of compounding. Compounding takes time, but you can truly start with $100 and over time it will grow. Myth number 3. Beating the market is impossible. It is obvious that people beat the market, right, guys? There's Warren Buffett, Ray Dalio, Peter Lynch, right? Charlie Munger, all these guys, they are beating the market every single year for many, many years. All right, let's look at this picture here on the left. You see Buffett versus the S&P 500. If you had put $100 in Berkshire Hathaway, which is Warren Buffett's company, if you had put 100 in the 1960s, it would now be worth $1.3 million. All right, that is a huge amount of gain. Now, to compare that, the S&P has grown to 11,000. So that is 110 times what your original investment is. That is quite respectable. And as you can see on the picture to the right, 84.2% of funds can't even do that in 50 years. All right? So Warren Buffett here is a legend. He has turned 100 into 1.3 million in that time frame. And most people cannot even turn it into 11,000. So yes, people do beat the market. And this all goes back to myth number 2, where I was talking about compounding. Compounding is the key, right? If $100 grows 10% the first year, now it's 110. The second year, it grows another 10%. That is $11 gained rather than 10 of the first year. And this goes on, and it will grow enormously. It is possible to beat the market. Myth number 4. The higher the risk, the higher the return. This one is also partially true, but some investors have learned to minimize their risk while maximizing their returns. This balance in risk versus reward is actually one of the secrets to beating the market as a whole. Charlie Munger always talks about how he minimizes his risk by finding great companies, businesses that make a lot of profit, right? And this really minimizes that risk. For example, this picture here is a pyramid of the different forms of investing, right? At the bottom is cash, 0 risk at all, right? Actually, there technically is a risk because there's inflation, right? Inflation is bad and it will hurt even the 0 risk investors. This is why you might want to take it a step or 2 higher. Government bonds, bank accounts, CDs, treasury notes. This is one step above basic cash, right? And this is very, very low risk. Like, what is the risk of a bank account? Next to nothing. I mean, you even get interest. The only risk is that they can't pay you back your money when you want it. And that does happen. For example, the 2008 crisis. Above that is real estate, mutual funds, large and small cap stocks, high income bonds. This is more risk, and there is the potential of losing all your money in these. But it's pretty low if you buy quality, right? For example, if you buy real estate, even if there's a real estate crash, land still has value. If you buy a great company like, say, Google, Google is not likely to fall. Facebook is not likely to fall to zero. None of them are likely to fall to zero. But the less quality, the more risk. This is where we go to options, futures, collectibles, cryptocurrencies. These are the small explosive ones, right? This is the new market sort of thing. And this is where all the risk happens. This is dangerous territory, but you can make a fortune off of it. I actually made quite a bit of profit from buying Ethereum last year. It's good stuff, right? But it's risky. And so you got to know this risk versus return and maybe have a balanced portfolio of several different things. I have silver, I have crypto, I have stocks. You can have your own different combination and it works pretty good. This is balancing that risk. All right, guys? Myth number 5. Buying cheap stocks is a sure win. No, it's not, right, guys? Because there's something called the value trap. And if you don't know what the value trap is, caution. Do not leave the video until I've explained it. Because if you buy a cheap stock with a low PE ratio and you think you are smart, think twice. There's a reason why that stock is cheap. Why are people not buying it? Well, maybe it has bad fundamentals. Maybe the company is not making any money or their debt is through the roof, right? If you don't know this and you're only looking at the PE ratio and, oh my gosh, it's at a PE of 2, right? That is not good. You need to know why it is down. And if you know why, then it might not be a value trap. But if you don't know why, 50% declines are possible. So please avoid this if you can. I have made that mistake before, and I do not want to see you do it. Alright, and if you want to see more of my channel, watch one of these 3 videos. I appreciate it a lot. And don't forget to like the video and subscribe to my channel for more content. Thanks guys so much, and have a great rest of your day.